Hello everyone, I'm Shweta ji from 3rd BCom A. My topic for the presentation: hedging techniques for interest rate risk. Needs for hedging interest rate risk. Hedging techniques for interest rate risk. Let's see the hedging techniques. Hedging techniques: traditional and basic approach. Matching and smoothing. Asset and liability management towards rate agreement. Need for hedging interest rate risk. If a business does not know its future interest rate may alter the weighted average cost of capital, and the outcome of net present value calculation may differ. There is of course a risk that if business had committed itself to variable rate borrowings, interest rate were low, a risk in the interest rates might not be sustainable by the business, and then liquidation become a possibility. Here ends my topic. Thank you, ma'am.
Myself Shweta NM from 3rd BCom A. International Financial Management Presentation. Traditional and basic approach. Matching and smoothing, asset and liability management, forward rate agreement. Matching and smoothing is my topic. Matching and smoothing. When taking a loan or depositing money, business will often have a choice or variable or fixed rate of interest. Variable rates are sometimes known as floating rates. They are usually set with the reference to benchmark. Matching. This approach requires a business to have both asset and liability with the same kind of interest rate. Smoothing. In this simple approach to interest rate risk management, the loans or deposit are simply divided so that some are fixed rate and some are variable rate. Looking at the borrowings if the interest rate rise. Thank you so much for watching. From Shweta NM.
Hello friends. So my topic is about assets and liabilities management. Meaning, assets and liability management is a practice of managing financial risk that arises due to mismatches between the assets and liabilities as part of an investment strategy in financial accounting. It is a process of managing the use of assets and cash flows to reduce the firm risk of loss from not paying a liability on time. Well managed assets and liabilities increase business profits. So here it talks about mismatches between assets and liabilities. If the mismatches are there, so it's a risk to the company. Then the process of managing the use of assets and cash flows to reduce the firm risk of loss from not paying a liability on time. If the liability is not paid on time, it is the risk for the firm. So if the well managed, if it is well managed by the management, it increases the business profits. Purpose and objective of ALM. An effective assets liability management technique aims to manage the volume, mix, maturity, rate sensitivity, quality, and liquidity of assets and liabilities as a whole so as to attain a predetermined acceptable risk reward ratio. The pyramids of stabilizing ALM systems. So the steps for ALM system is net interest income, net interest margin, economic equity ratio. Assets and liability management. This relates to the periods or durations from which loans, that is liabilities, and profits, that is assets, last. The issues arised are not confined to variable rate arrangements because a company can face difficulties where amounts subject to fixed interest rates earnings mature at different times. Example for assets and liability management, that a company borrows using a 10-year mortgage on a new property at a fixed rate of 6% per year. The property is then leased for 5 years at a rent that yields 8% per year. All is well for 5 years, but then a new lease has to be arranged. If rental yields have fallen to 5% per year, the company will start to lose money. It would be wiser to match the loan period to the lease period so that the company could benefit from lower interest rates if they occur. Thank you.
Hi ma'am, my name is Tasneem Firdos. My international financial management PPT presentation topic is forward rate agreements. Forward rate agreements basically means where two parties are involved, and it is similar to forward contracts. The definition for forward rate agreements is as a forward rate agreement is a cash settled. Usually the agreement occurs in cash, and it is a contract between two counterparties where a buyer is borrowing and the seller is lending, and the deposited money is known as notional sum, and a fixed rate is also specified, that is known as FRA rate, forward rate agreement rate, and a specific period of time starting and an agreed date in the future. They specify a date which starts as the agreed date in the future. For example, two parties enter into an agreement to borrow 1 million after 60 days for a period of 90 days at say 5%. So here the agreement is of 1 million which has a maturity date of 90 days at a fixed rate. Agreement is 5%. Characteristics of FRA forward rate agreements are: the payment is made only at maturity, the deposited amount between the counterparties is known as notional amount, and it is usually cash settled. Thank you, ma'am.
Interest rate derivatives. Interest is something charged for fixed rate and for the first duration. The duration may be big or small. Here we can borrow money at a precise rate of interest and pay the obligation on monthly basis. Sales create the obligation to borrow funds and pay interest, whereas buying will create obligation to deposit money and make investment and receive interest. The EX here such as ICE.
Hello ma'am, myself Umme Hurin, HF of 3rd BCom A section. My topic for presentation is borrowing or depositing. Depositing and earning interest. The depositors fears that the interest rates will fall as this will reduce income. If interest rates fall, future prices will rise, so buy future contracts now at relatively low price and sell later at higher price. The gain on futures can be used to offset the lower interest earned. Deposit is nothing but keeping money. Before explaining this point, I'm going to explain about the futures contract. Futures contract is nothing but a contract between two parties where buyer and seller agree to buy and sell a particular asset of specific quantity at a predetermined price for a specified date in future. Future contract is nothing but an agreement between the buyer and seller. Both the parties agrees to buy a particular product at a particular price for a particular date in future. See, the depositors obviously fear when the interest rates falls, because if the interest rates falls, their income will also reduce. So these depositors, what they will do is they will buy future contracts at lower prices. When the interest rate is low, they will buy these future contracts. Later on, they will sell these future contracts when the interest rates are high. The gain on futures can be used to offset the lower interest earned. So they will keep these gains to offset the losses earned in future. Second point is borrowing and paying interest. The borrowers fear that the interest rates will rise, as this will increase expenses. If interest rates rise, future prices will fall. So sell future contracts now at relatively high price and buy later at lower price. What is borrow? Borrow is nothing but to take or receive something from somebody that you intend to give back, usually after a short period of time. So these borrowers fears that if the interest rates rise, then the expenses will also increase. So in borrowing and paying interest, the borrowers sell future contracts at high price and buy at lower price when the interest rate is low. For example, assume if someone wants to buy a crude oil in September for a future contract, so they will make a future contracts. They will buy 200 barrels of oil from the agreed price as of September, that is whatever is the market price at that time in September. Whatever is the market price in September, they will buy at the same price. Now both the buyer and seller are obligated, they are committed to buy or sell these 200 barrels of oils at the agreed price. This is a future contract, and this is borrowing and paying interest point. Thank you.
Hello, my name is Ume Ayman. I'm from 3rd BCom A. My presentation is on the subject of international financial management. My topic is about interest rate option. What is interest rate option? An interest rate option is a financial derivative that allows the holder to benefit from changes in interest rate. Interest rate can speculate on the direction of interest rate with interest rate option. It is similar to an equity option and can be either a put or a call. Interest rate options are option contracts on the rate of bonds like US Treasury securities. Effects of interest rate options: an investment tool in which the payoff depends on the future level of interest rate. Underlying asset is typically a treasury bond. Changes in interest rate. Opportunity for interest rate option is investors can capitalize on their outlook on the changes in interest rate. Risk for interest rate option is interest rate moves can adversely affect the value of their investment. Advantages of interest rate option. Interest rate option provide the right to receive one interest rate and pay another. The next is an interest rate call pays off if the interest rate ends up above the strike rate. The holder pays the strike rate and receives the market rate, usually LIBOR. An interest rate put pays off if the interest rate ends up below the strike rate. The holder pays the market rate LIBOR and receives the exercise rate. Thank you.
Hi ma'am, this is Varsha Saravanan of 3rd BCom A. Today I am going to present the PPT of the subject International Financial Management of the chapter Risk Management. Here, if the interest rate falls, the future contract price will rise. Let's say to 97. The borrower not buy at 97, then they exercise the option to sell at 95. So the option is allowed to lapse and the business will simply benefit from the lower interest rate. So here they say that if the interest rate falls, the future contract price will rise. And then the borrower would sell at 95 and he would not buy at 97, and from this he might be benefited from the lower interest rate. And then, if using simple future contracts, the business would buy futures now and then sell later. Here they say that the business would buy the future contracts in today's price and then they would sell those things later. And the option to buy this is known as a call option. If interest rate falls, the futures contract price will rise, let's say to 97. The investor therefore sell at 97, then exercise the option to buy at 95. The gain on the option is used to offset the lower interest that has been earned. For here the investor would sell at 97 and then he would make an option that to buy at 95. By this by this he can offset the lower interest that which he has been earned before. If interest rise, the future contract price will fall, let's say to 93. Clearly, the investor would not sell futures at 93 and exercise the option by insisting on the right to sell at 95. The option is allowed to lapse and the investor enjoy extra income from the higher interest rate. This is of vice versa. When interest rate rise, the future contract price will fall. When the interest rate falls, the future contract price will rise. And here, when interest rise, the future contract will fall. So, if it is at 93, then the investor would not sell it at 93. He would wait or he would exercise the option and he would sell at 95. And by this, the investor would enjoy income from the highest interest rate. Options therefore give borrowers and lenders a way of guaranteeing minimum income or maximum cost, whilst leaving the door open to the possibility of higher income or lower cost. These heads, I win, tails you lose, benefits have to be paid for a non-returnable premium as to be paid up to acquire the options. Here, I would give an example as we all work for a profit and we also think that our cost should be low and our profit or the income and our income should be high than the cost which we have incurred. And the same thing would be here for both the borrowers and the lenders. It is like a minimum income or a maximum cost. Thank you, ma'am.
Hello everyone, I am Vinodini R from 3rd BCom A. My topic for the presentation is interest rate derivatives. Under that, interest rate caps, floors, collars. Interest rate caps. A caps involves using interest rate options to set a maximum interest rate for a borrower. If the actual interest rate is lower, the option is allowed to lapse. Interest rate cap is a maximum amount of interest that can be charged to a customer. Interest rate floors. A floor involves using interest rate option to set a minimum interest rate for investor. For the actual interest rate is higher, the investor will let the option lapse. A interest rate floor is an agreement between the seller or a provider for the floor and an investor which guarantees that the floating rate of return will not fall below the specified level. Interest rate collar. A collar involves using interest rate option to confine the interest paid or earned within a predetermined range. A borrower would buy a cap and sell for a floor, thereby offsetting the cost of buying a cap against the premium received by selling a floor. A depositor would buy a floor and sell a cap. Interest rate collar is an instrument that combines both a cap and a floor. It is an option used to hedge explore to interest rate moves.
Hello ma'am, my name is Yasin Sabah from 3rd BCom A. My topic is interest rate swaps under interest rate derivatives. What is swap? Here, swap means exchange. Interest rate swaps. It is an interest rate derivative, a contract which involves exchange of interest rate between the two parties. Let's go through this. Interest rate swaps allows companies to exchange interest payments on an agreed notional amount for an agreed period of time. So here the interest rate swaps, it allows the companies to exchange interest payments on an agreed total amount or fixed amount for a set period of time. So what exactly is interest rate swap? It is a transaction or an agreement which involves an exchange of one stream of interest obligation for another. So here interest obligation means the obligation of the company to pay interest on securities. Swaps may be used to hedge against adverse interest rate movements. So here this swaps is also used to protect against the unfavorable interest rate movements, are to achieve a desired balance between the fixed and variable rate debt. Interest rate swaps allows both the counterparties to benefit from the interest payment exchange by obtaining better borrowing rates than they are offered by a bank. So here these swaps, interest rate swaps, allows both the parties to get a benefit from the interest payment exchange where they can obtain better borrowing rates better than what the bank offers them. Interest rate swaps are arranged by a financial intermediary such as a bank. So this interest rate swaps are arranged by a bank which is a financial intermediary. So the counterparties may never met. However, the obligation to meet the original interest payments remains with the original borrower if the counterparty defaults, fails. But this counterparty risk is reduced or eliminated if a financial intermediary arranges a swap. Here, if this financial intermediary such as a bank which arranges the swap, if it arranges the swap, the risk is reduced or we can see it is eliminated. So here interest rate swaps allows company to hedge over a longer period of time. It allows the companies to stay for a longer period of time than other interest rate derivatives. But it doesn't allow the company to get a benefit from favorable movements in interest rates. So here LIBOR means London Interbank Offer Rate. Okay, so here the most common type and the most popular type of swap is plain vanilla swap. Involves exchanging fixed interest payments for variable interest payment on a same notional amount. So here this in a plain vanilla swap, they allows two parties to exchange fixed and floating cash flow on an interest bearing investment or loan. So here fixed and floating. If a loan has a fixed rate of interest, it remains constant. If it is a fixed interest rate, it remains constant for the duration of the loan. If the loan has a floating interest rate, then the interest rate keeps on fluctuating till the duration of the loan. Till the time it keeps on fluctuating. This is known as plain vanilla swap. The next is the currency swap. Another form of a swap is a currency swap, which is also an interest rate swap. So currency swap are used to exchange interest payments and the principal amount in different currencies over an agreed period of time. So here currency swap, it is a transaction in which two parties exchange an equivalent amount of money with each other but in different currencies. They can be used to eliminate transaction risk on foreign currency loan. So it is also used to reduce the risk or eliminate the transaction risk on foreign currency loan. For an example, they have given here is the fixed rate dollar debt for a fixed rate euro debt. Here the dollar debt is exchanged with a fixed rate euro debt. Thank you. This video is represented by Group 10. Thank you, ma'am, for your time and consideration.